So you're self-employed and you're thinking about using bank statements to prove your income in order to qualify for a mortgage. It's a great alternative to using your tax returns. Now, remember, your tax returns are always going to give you a better deal. Most of the time, I should say, are going to give you a better deal. You're going to get better interest rates and or lower fees. You're going to require smaller down payments when you're using your tax returns. The drawback is maybe your tax returns don't look so good, you don't qualify for anything, or not as much as you're hoping for, or B, you've got to file your taxes showing such a huge amount of profit that it puts you in a position where it doesn't make sense to pay a bunch of extra money to the IRS just to save a little bit of money on the mortgage. So let me explain to you how business bank statements work. First of all, there's multiple types of personal accounts, business accounts, commingled accounts. I'll get into that in a different video. Today, I'm simply giving you the big picture. Bank statements are all about cash flow. We're simply looking at how much money is your business depositing every single month. And we're looking at what sources of deposits. So we don't take every deposit. It depends on the nature of your business. Now, this is where it is critical to work with a loan officer that understands how to use these loan programs. Because if an underwriter who makes the final decision simply looks at your bank statements, they're going to look for recurring deposits. And if it doesn't fit the pattern, they're going to throw that deposit away. Well, what I look at is tell me the story about your business. Tell me how you receive your deposits, under what circumstances do you get them, and let's make sure that we explain that to the underwriter so that they can count every dollar of your revenue. So very simply, we're going back 12 months, sometimes 24, but most of the time 12 months. And we're looking at the deposits that we can explain as being business deposits. Now, cash deposits can be business deposits. You've got a lot of people who regularly receive income via cash. I did a loan for a barber recently. Barbers are paid in cash all the time. So we showed cash deposits, and they were periodic deposits. You didn't deposit every single day. And we were okay with it because we explained that's where it came from. So we figure out how much are you depositing each month on average. And then the default is we assume half of that is profit and half of that is expenses. So we have an expense ratio, and it's a standard expense ratio of 50% of your deposits are considered to be expense and 50% are considered to be profit. So for a lot of business owners, that's it. Game over. We're done, because you deposit a lot of money into your business depending upon the type of business that you're in. And we get to count half of that, and that's more than enough. I had a contractor. He was actually a cement contractor, did flat work, hardscape. And he had a lot of deposits. Now, a lot of his deposits went away. He had high expenses because, well, he's got to pay for the cement. He's got to pay for the labor, got to pay for the tools. And so he might have only kept, in the end, he might have only told the IRS he kept 10% of that as profit in the end. But I get to count 50% of it automatically as profit. That's the game changer for using bank statements to qualify. And here's the next best part. You can actually we will allow you, if you got a letter from your CPA or licensed tax preparer that said your expense ratio is blank, less than 50%, I can use that number as long as the story makes sense. Now, if you're in car sales, so you resell cars, you buy used cars and you resell them, you might have, depending upon what you're buying, you might be buying junkers and you can make a significant profit on it. So maybe that would make sense that you have a less than 50% expense ratio. But if you're buying brand new cars, the markup on those is like this. So we're not going to believe that you have a small expense ratio. We have to understand the story behind it. But if it makes sense, if you're a consultant and you are running a business out of your home, you have very low expenses. We would expect that your expense ratio is lower. But to use anything less than 50%, we have to get a letter from a tax professional telling us that what your expense ratio is. Here's the challenge. A lot of tax professionals are shying away from writing those letters. So if your tax person is not willing to write that letter, we can still use bank statements, but we have to use 50% as the expense ratio, and 50% is the remaining amount that we're going to count as your profit. What types of businesses does this work well for? Businesses that deposit a lot of money regularly in the bank. Now, if you're a cash business and you don't deposit it in the bank, this isn't going to work for you. But if you are a business that deposits your money regularly in the bank, you for sure should be considering using a business bank statement loan, even if they're personal bank statements. I'll explain in a different video, but essentially, whether you have a separate business account and personal account, or you use a commingled account for everything, it's okay. We can use your deposits as long as we can see and outline that they're business deposits. We're not going to count that $250 Venmo that says my share of Mary's birthday gift right on the bank statement. We're not going to count that. We're not going to count transfers from other bank accounts that you're transferring in, because those are deposits, but they're transferred in. We're going to count deposits that are coming in, and we like to only use one bank statement. There's times when it makes sense and we'll use multiple bank statements, but we like to only use one bank statement instead of two of them. We're worried about money moving between the two. So ideally, use one bank account for your business deposits, and we automatically count 50% of that. Now, if you're in a position where you have separate business and personal accounts, sometimes we can use your personal statements and we count 100% of that. Why? Because all the expenses come out of your business account. So therefore, any deposits that are sent from your business account to your personal account is your profit in our view. Therefore, we count 100% of your deposits into your personal account, as long as we can prove you have a business account and prove that the business expenses come out of that business account. Now, here's who this is not perfect for. It's not perfect for independent contractors who are paid on a 1099. Why? Because you should be using a 1099 loan. With 1099 loans, we count 90% of your 1099. That's it. That's it. 90% of your 1099. I don't need a CPA letter because we assume if you're an independent contractor, your expenses are relatively low. So if you're paid on a 1099, don't use bank statements. If you are not paid on a 1099, then bank statements may be a great option for you. Reach out to me if I can help you to qualify for a mortgage. I am interviewing for the job of being your lender. There's going to be a QR code sliding around here somewhere that you can scan in order to reach out to me and schedule an appointment, and visit my website, caniqualify.info. Caniqualify.info. It's got a lot more great information about ways we can help you as a business owner qualify for your next mortgage.